Summary of Flash Boys. A Wall Street Revolt by Michael Lewis, written and narrated by Janky Mind. Introduction. Flash Boys delves into the shadowy depths of the U.S. financial markets, unveiling an examination of a concealed side. It also narrates the emergence of a novel stock exchange known as IEX, conceived to counter a manipulated system that took advantage of technological gaps and a lack of openness. The process of investing in the stock market has undergone a transformation. Previously, it involved interacting with a broker who would place orders, and perhaps traders would shout numbers on the New York Stock Exchange floor. However, those times have evolved. Presently, the entire process is executed electronically, relying on an intricate network of servers, codes, and algorithms. While the New York Stock Exchange was once the central hub of trading, it is now only one of many public and private exchanges. The shift towards electronic trading aimed to enhance safety and efficiency by minimizing human involvement. Yet, as we'll discover in this concise audiobook, it inadvertently provided an opportunity for opportunists who eagerly exploit the very investors that sustain the market. Chapter 1: A fresh predicament called for an innovative remedy. The instant Brad Katsuyama executed the enter command, he became acutely aware of an issue. This occurred in 2007, when Katsuyama was employed at the Royal Bank of Canada in New York. The issue revolved around the fact that whenever he pressed enter to place an order, such as purchasing 10,000 shares of Intel, the price would suddenly spiral out of control. Despite anticipating a potential sale at $22 per share, the moment he initiated the action, the share price would nosedive, resulting in substantial losses. This experience shattered Katsuyama's trust in the market. Compounding the problem was the increasingly intricate nature of the stock market, baffling even seasoned Wall Street brokers with its intricate nuances. However, through the assembly of a multidisciplinary team of experts and their collaborative efforts, Katsuyama managed to unravel the exact nature of the issue. The crux of the problem lay in the occurrence of front-running on Katsuyama's orders. The instant a substantial order, such as the 10,000 Intel shares, surfaced in the market, algorithms employed by high-frequency trading firms would preemptively position themselves ahead of the order before it could be disseminated and spread across various stock exchanges. This process operated in milliseconds, representing the time it takes for an electronic order to traverse from Manhattan to New Jersey. This brief period was enough for these firms to inundate the market with competing orders, inducing price fluctuations prior to the completion of the transaction. This maneuver is commonly referred to as front-running. Leveraging their expert understanding of the fiber optic networks within the tri-state area, Katsuyama and his team developed a tool named Thor. This ingenious program could stagger the release of an order, ensuring that it reached all the different stock exchanges simultaneously, effectively thwarting any opportunity for front-running. Nonetheless, it became evident that Thor was merely a temporary solution to a systemic predicament, one that was being facilitated by some of the most prominent banks on Wall Street. A convoluted system of incentives was in operation, allowing HFT firms to rake in substantial profits, up to $160 million per day, through tactics that essentially disadvantaged investors. A loophole within electronic trading had been discovered and ruthlessly exploited, with little regard for the broader ramifications it had on eroding investor trust and destabilizing the market. Addressing this issue necessitated a more comprehensive approach than what Thor could provide. Chapter 2: A brave new stock exchange. An innovative solution took shape in the mind of Brad Katsuyama, encompassing two fundamental aspects. The first involved an extensive campaign of enlightenment. He engaged with major investors and influential hedge fund managers, laying bare the ways they were being exploited within the existing market framework. However, Katsuyama's vision transcended these efforts as he contemplated a grander notion, the creation of a novel stock exchange characterized by complete transparency and a guarantee of safeguarding against the market's predatory forces. Yet, there existed certain obstacles on this path. Astonishing as it might seem, investors who placed orders through banks and brokers lacked the means to ascertain which stock exchanges ultimately executed their orders. This lack of transparency largely played to the advantage of banks. Many of these financial institutions operated what were known as dark pools, essentially private arenas for stock trading where various activities occurred discreetly, shielded from public scrutiny. The more trading activity, the more beneficial it was for these banks. Unfortunately, even though such activity often obstructed legitimate transactions, few entities were generating more trade than the high-frequency trading firms. Katsuyama, however, had several factors working in his favor. The repercussions of the 2008 financial crisis prompted certain banks to recognize the potential hazards associated with short-term gains. Furthermore, instances of sudden and severe market crashes, like the one on May 6, 2010, when the market plunged by 600 points only to recover within minutes, were growing in frequency. The connection between this heightened instability and the manipulative practices of predatory HFT firms was not difficult to establish. When Katsuyama and his team successfully established their own stock market, christened the Investors Exchange, and launched trading operations on October 25, 2013, it marked a significant gamble. The sustainability and impact of their endeavor hinged on a substantial volume of trades. Providentially, Katsuyama found an ally in the form of Goldman Sachs. In the aftermath of the 2008 crisis, this major investment bank had a vested interest in aligning itself with the right side of history when the next market crash occurred. Consequently, on December 19, 2013, a collective sigh of relief reverberated through IEX as the first significant order from Goldman Sachs arrived. Almost instantaneously, their fledgling venture surpassed the American Stock Exchange in terms of market share. Their legitimacy was immediately established, underscoring their transformative role in promoting transparency and rectifying a flawed financial system. Summary: from 2007 onward, a small cluster of individuals within Wall Street came to realize that the American financial system was being manipulated. Aided by prominent banks, high-frequency trading companies were engaging in order manipulation, generating immense profits, often in the range of hundreds of millions of dollars per day. Under the leadership of Brad Katsuyama, these insiders initiated the creation of a fresh stock exchange, with a foundation of openness and equitable practices, aiming to rectify a flawed system. This audiobook summary was brought to you by Janky Mind. We hope you enjoyed it.